Good morning, guys, from Pierkowski Insurance Agency. Just wanted to reach out to you from achieving your goals at breakneck speed. What we're doing is we're going to continue our little segments on annuities and different parts of annuities. In our last segment, we talked about kind of the basic understanding of some things with annuities. And as we know, there's different annuities out there, variable annuities and immediate annuities and fixed annuities. And within that, there's an equity index in those fixed annuities. Today, we're going to continue our talk on equity indexed annuities or a fixed annuity with indexing options. And I want to talk about one specific topic that we celebrate. That's really a good thing that's misunderstood out there with folks that think they know about annuities, that folks have, to be very honest with you, I speak straightforward. If you think you're YouTube certified and you're YouTubing annuities or you're searching the internet and don't know anything about that and haven't talked to a registered insurance advisor, you really want to stop doing that. You want to talk to an insurance advisor like myself so we can show you actual information from the insurance companies and go over what they actually are and not be YouTube certified as so many people out there want to do that with many different things. So today we're going to talk about surrender periods and surrender charges. And we celebrate those things. Those are really good things. And really what a surrender period is it's a period of time that the insurance company wants you to keep all of your money in the annuity for a period of years, whether it's a 10-year or a 14-year. I'll talk to those two examples, whether the annuity had a bonus or it didn't have a bonus. But it's simply a period of time that says, hey, you've got a 10 or 14-year surrender period. We ask that you don't close and cash out your annuity during those 10 or 14 years. And really, it's because of the trade-off. The insurance company is giving you some guarantees. Now, there's different guarantees within the annuity, and the guarantee is that your money is never going to go backwards by any fault of the insurance company. Secondly, there's guarantees with guaranteed income. We'll get into that later, but the surrender period just guarantees a specific period of time that if you keep your money there, that you know that it's going to be guaranteed that it's never going to go backwards. Now, during that time, there's a surrender charge. So that would mean in a 14-year, for example, if you purchase the annuity, today, and in 3 years, you decided that you were just going to do one of two things, that you were going to just all of a sudden close your annuity and cash it out, and it didn't meet some of the guidelines that would allow you to do that with no penalties, then there's going to be a surrender charge that you're going to have to pay. And the cool thing with that is that we know exactly at any given point how much you're going to pay if you decide to close your annuity out. For example, I've seen some clients this year, a lot of different women, and some of them have lost 5, 10, 11% already in the month of January. Some of them have lost 20% already in the month of January and February. So they've already lost that money in their accounts. But what if you had an equity indexed annuity and that after 1 year, you decided that you just wanted to close your annuity? Now, I don't recommend this at all, but you just cashed it in. And at the end of 1 year on a 14-year term with a specific product and company, that you were going to have to pay 14.75%. And we knew exactly to tell you what the future was going to look like. Some would say, well, gosh, I'm going to lose all that money. Well, for the folks that have already lost 10 and 20% this year, we don't have a crystal ball in the market as to say how much you're going to lose, make, or get a return on. So we can actually give you a guarantee on what a surrender charge would be. And that's what we celebrate. Now, in all the years of my industry, I haven't had folks surrender an annuity. And I've been doing this since 2015 because there's different ways that you can do it. So the surrender period is just a period of years that said, hey, we want to keep your annuity. We're giving you some guarantees. Maybe we've given you a bonus. Your money's not going to go backwards by any fault of the insurance company. So for that trade-off, we want you to keep your account open at least those 14 years or 10 years. And then after those 10 or 14 years are done, you can keep your annuity forever. You can keep it there. Or you could close it out and not have any penalties from the insurance company. Of course, you may pay taxes to the government, but you wouldn't have any penalties from the insurance company. So the surrender period is a period of years that we celebrate, because we can pinpoint exactly each year during those 14 years what your surrender charge would be. And what if we could do that in the stock market? What if, as advisors, people could say, you know what, Bill and Mary, we know this year that at the worst case, you're only going to lose 14.75%. Nowhere in the market can we do that, or is it designed to do that? So we celebrate that. We don't pick on that. And the charges are, again, what they would charge. And they go down every year during those 14 years. So as you learn about annuities and its surrender charges and surrender periods, we celebrate those. And we're super excited about them because we can tell you exactly what the picture looks like. Alrighty, so here, as we continue our next lessons here, and we'll go on next week, but achieving your goals at breakneck speed is something we do at Pierkowski Insurance Agency that we've done, we're doing, and we continue to do for those that work with us. Have a great day.